In less than a week, one of the world's most important physical gold hubs hit the brakes twice. On February 3rd, 2026, margin requirements on key gold contracts were lifted from 16% to 17%, and the daily price limit was pushed from 15% to 16%. Then, just 3 days later on February 6th, 2026, the same exchange tightened the screws again, raising those margins from 17% to 18% and expanding the price limit from 16% to 17%, effective with the February 9 settlement. It's a signal that volatility and settlement risk were rising fast enough to force policy in real time. And here's the part that breaks normal expectations. While the paper price of gold can look calm for hours at a time, the infrastructure underneath it was being reinforced in real time, not months, not weeks, in 72 hours. They said modern gold markets were too deep, too liquid, too efficient for stress fractures like this to matter. Yet the collateral requirements were rising as if someone on the inside could already see a wave coming. Because when margins climb, it isn't a headline. It's a message. It says the people who clear trades, who guarantee settlement, who manage the risk of thousands of positions are seeing volatility as something that can cascade. It says liquidity is not infinite. And it says the spread between gold as a number and gold as a deliverable thing is starting to widen. Welcome to Channel Name, where we decode what matters before it's common conversation. Around here, we don't chase the loudest narrative. We follow the mechanics. Spreads, margins, flows, and the quiet institutional decisions that precede the big moves. If you've ever felt like the story changes after the price changes, you're in the right place. And if this kind of analysis feels like listening to that wise elder who notices the weather shift before the storm, stay close. Drop a comment with where you're watching from, because this story looks different depending on which market you're closest to. Now, let's reconstruct what actually happened and why traders keep missing the trigger. The first clue is in the timing. On February 3rd, 2026, the exchange announced higher margins for a set of contracts tied to deferred delivery and spot-style settlement. LUT plus D, MLUT plus D, ALUT plus N1, ALUT plus N2, plus two name contracts tied to June and December settlement. The margin rose from 16% to 17%, effective the very next settlement day. The daily price limit was widened. 99 saw its required deposit jump from 120,000 Chinese yuan per lot to 150,000 yuan per lot. In a vacuum, those are just percentages. But in market reality, they are a lever pulled on leverage itself. Higher margin means less borrowing power per position. It means the same trader must post more collateral to maintain the same exposure. And that does two things at once. It dampens new speculative demand, and it forces existing leveraged holders to reduce positions if they can't meet the higher requirement. Then came the second clue. On February 6, 2026, before the market even had time to fully digest the first change, the exchange raised margins again from 17% to 18%, with the new requirements applying at the February 9th settlement. The daily price limit was widened again. Silver was tightened too, with the key contract's margin lifted from 23% to 24%, and its price limit from 22% to 23%. So why does that matter for the gold versus paper spread? Because the spread is not just a price gap. It is a symptom of two different markets trying to clear the same reality with different tools. Paper gold is a promise. It's a contract, a claim, a line item. It can be created, netted, offset, rolled, and cash settled through mechanisms that rarely require metal to move. Physical gold is a thing. It sits somewhere. It has a bar number, a refiner stamp, a purity, a location. It takes time to ship. It requires trust and custody. And it becomes most valuable not when it's talked about, but when it's scarce at the exact point someone needs to deliver it. When everything is smooth, the two markets track each other closely. The spread between spot and a nearby futures contract might be a few dollars, reflecting financing costs, storage, and the friction of time. But when the system is stressed, that spread can widen because the market is no longer pricing gold. It's pricing the ability to settle gold obligations without something breaking. This is where it gets interesting. Margin hikes are a stress response, but they also become a stress amplifier. The first hike can be interpreted as caution. The second hike, 3 days later, is the signal that the caution was not enough. And if you've watched this movie before, the pattern is familiar. In 2008, when the credit system cracked, it wasn't the headlines that told the truth first. It was the spreads. Funding spreads, swap spreads, the plumbing. But the infrastructure was already screaming. Then came the forced selling. Then came the scramble for collateral. Then came the realization that liquidity can vanish precisely when it's priced as abundant. In March 2020, we saw a similar dynamic in gold itself. The world was seizing up. Flights were grounded, refineries slowed, logistics tightened, and suddenly the clean relationship between gold prices across venues fractured. A mechanism known as exchange for physical, or EFP, exploded in use. On March 12, 2020, 38,469 gold EFPs traded in a single day. That implies 3,146,900 ounces, or nearly 120 metric tons, shifting through a settlement bridge between futures and the London spot market. That number is enormous, not because someone physically loaded 120 tons onto a truck overnight, but because it reveals desperation to convert one form of exposure into another form of settlement. In 2020, the public story was that gold is gold everywhere. The spread was the message. The EFP surge was the message. The logistical premium was the message. In 2024, market watchers again described the spread between spot and the front futures, month moving from the normal range of about $2 to $5 to a stressed range of $30 to $50 at points. Whether the exact number in any moment varied, the point is that the spread widened far beyond what ordinary carry costs can explain. And once again, the debate returned. Is this just volatility, or is it a dislocation between paper claims and physical availability? Now in early 2026, you have a new ingredient. Official tightening in one of the world's most important physical trading ecosystems, happening twice in the same week, right as the East-West conversation heats up again. So who are the players, and what are they actually doing? Start with the obvious institution, the exchange itself. An exchange is not a neutral stage. It is a risk-managed machine. It sets contract terms, margin requirements, daily limits, and settlement rules. Those parameters determine how stress gets distributed. When an exchange raises margin, it is effectively demanding more high-quality collateral from participants. That collateral tends to be cash or cash-like instruments. In a tight liquidity environment, that demand competes with every other demand for cash across the financial system. Then you have clearing members and large brokers. They intermediate between customers and the exchange. They have their own risk controls. If the exchange raises margin, the clearing members often raise it further for clients. That can trigger a chain reaction. A trader who is comfortable at 16% may be forced to meet 18% at the exchange, and perhaps more at the broker. The trader sells positions to raise cash. That selling pushes prices. Volatility increases. The exchange sees volatility and tightens again. The loop feeds itself. Now layer in the global structure of gold. There is a futures complex where paper contracts define price discovery for many participants. There is a London spot structure with its own conventions and settlement mechanics. There are physical hubs in Asia where demand is more directly tied to bars and immediate delivery. And there are central banks, sovereign funds, and large institutions whose behavior is not about trading, but about reserves, collateral, and confidence. When a margin hike hits in a major physical hub, it intersects with this network. It affects hedgers. It affects arbitrage desks that keep prices aligned across venues. It affects jewelry fabricators, refiners, and importers who manage exposure. And it affects speculators who ride volatility. The same policy change can push all of them in the same direction at the same time, toward reducing leverage and raising cash. This is the part no one is discussing with enough precision. Margin hikes don't happen because the price is high. They happen because the risk is high. Risk is not price. Risk is speed, correlation, liquidity, and the potential for a small move to force large players to act at the same time. So let's talk about the dislocation itself, the gold versus paper spread, and the trigger traders miss. Traders often look for a single headline, a central bank announcement, a shock inflation print, a dramatic event, but spreads widen for structural reasons, and those reasons are often hidden in the settlement layer. The trigger is not the story. The trigger is the constraint. When the market is functioning, paper claims can be rolled smoothly. If someone is long a futures contract and doesn't want delivery, they sell it and buy a later one. If someone is short, they roll. The system nets. Physical delivery is a small slice of total open interest. The existence of delivery options is enough to anchor price, even if actual delivery is rare. But when a stress event hits, the assumptions change. A participant who expected to roll may need to close. A participant who expected to settle in cash may face a counterparty demanding metal. A participant who expected metal to be available at a predictable premium may find that bars are tied up, shipping lanes are constrained, or the right bar sizes are not where they're needed. At that moment, paper and physical diverge because they are clearing different constraints. Paper clears balance sheets, physical clears logistics. Now consider what margin changes do in that environment. They reduce leverage, which reduces the ability of arbitrageurs to compress spreads. Those arbitrageurs are the shock absorbers of the system. They borrow, they short here and buy there, they transport risk across venues, and they earn the spread. But they can only do that if their financing terms are stable. Raise margin, and you raise the cost of carrying positions. The shock absorber stiffens. The spread can widen further. This is why the trigger traders miss is so often a collateral event rather than a price event. The collateral event changes behavior before the public narrative catches up. Let me show you what the evidence looks like when you line it up. First, the margin hikes themselves are the evidence. A jump from 16% to 17% and then to 18% within days is a rapid tightening. It signals that recent volatility or flow was enough to warrant emergency recalibration. The exchange also widened daily price limits, allowing larger moves before halts or constraints. That's an admission that the market's expected range had expanded. 99 margin deposit from 120,000 to 150,000 yen per lot is not symbolic. It is a direct increase in cash tied up per contract. That reduces the flexibility of participants who might otherwise provide liquidity. Third, the fact that silver was tightened alongside gold matters because silver is often the volatility canary. When silver margin rises, it's frequently because speculative interest and speed have increased. That spillover tells you the risk committees were looking at a broader precious metals complex, not an isolated gold issue. Fourth, the East-West pricing story adds tension. 0.40 RMB per gram on February 9th, 2026. The numbers themselves reflect local conditions, currency context, and demand dynamics. But the key is that when regional benchmarks surge, it invites arbitrage. And if the arbitrage becomes difficult because of margin, currency constraints, or physical bottlenecks, the dislocation persists. To understand why this matters, it helps to zoom in on what a spread really represents in precious metals. A spread is the price of friction, the price of time, and the price of trust. When the spread is small, the market is saying these venues and these promises are interchangeable. When the spread is large, the market is saying interchangeability is breaking down. There is a reason the most experienced desks obsess over basis and carry. Gold is supposed to be the easiest commodity to arbitrage because it is durable, uniform, and stockpiled. Oil needs specific storage and delivery windows. Wheat spoils. Copper varies. Gold sits. In theory, that should keep spreads tight. So when the spread widens anyway, it is a flare. It is not about the metal changing. It is about the system around it changing. That's why historical parallels matter. In 1971, when the monetary anchor changed, the price of gold was no longer a fixed policy number. It became a market number. The early years were defined by shocks, controls, and a search for a new equilibrium. In 1980, after years of inflation pressure, gold spiked and then violently reversed as policy tightened and leverage was squeezed. The pattern was simple. When confidence in paper eroded, demand for metal rose, and when collateral and rates tightened, leveraged demand was forced out. In 2011, gold approached a peak as sovereign debt fears and policy responses collided. In 2013, the price fell sharply in a short window as large paper flows and liquidation cascades hit the market. Yet physical demand increased at lower prices, and premiums appeared in places where supply could not instantly expand. The lesson was that paper can move faster than physical, and speed itself becomes a weapon. Now let's make the mechanism simple. Imagine a crowded theater with two kinds of tickets. One is a digital reservation. The other is a wristband that physically gets you through the door. On a normal night, nobody cares which you have because the ushers accept both. The price of both tickets stays close, but if a fire alarm goes off, the system changes. Suddenly, the ushers demand wristbands because certainty matters more than convenience. People holding only reservations pay up to convert them, and the gap between paper and physical tickets widens. Margin hikes are like theater management demanding bigger deposits from anyone who wants to trade tickets inside the building. In a panic, defaults rise. If someone can't pay, the whole system suffers. So management forces participants to bring more cash to the table. That protects the building, but it also reduces activity, and it traps people who are relying on easy liquidity. In markets, this shows up as forced selling. If a participant is long paper gold with leverage and margin rises, they need cash immediately. They might not want to sell, but they must reduce exposure to meet requirements. When many participants face that at once, prices can drop, even if underlying demand for metal is firm. That is why you can see a day where the chart looks heavy while physical buyers step in. The chart reflects collateral mechanics. The physical reflects long-term preference. So when you hear people argue about whether the gold price is real, notice what they're debating. They're debating which constraint matters more in that moment. The constraint of balance sheet and collateral, or the constraint of metal in the right form in place. In calm times, the balance sheet constraint dominates, because most participants are trading risk, not taking delivery. In stressed times, the physical constraint becomes visible because the minority who truly need metal cannot be satisfied with paper. That is why a rapid sequence of margin hikes is such a powerful tell. It's a sign that the balance sheet constraint is tightening quickly. And when that happens, spreads don't need a headline trigger. The trigger is mechanical. The cost of staying in the trade. So what does this mean going forward? Historically, when the infrastructure tightens and spreads widen together, the market is preparing for an unwind. Not because someone decided it should, but because the system is moving from an environment where leverage is cheap and settlement is assumed to an environment where leverage is expensive and settlement is questioned. There are usually three broad outcomes, and the path depends on whether the stress continues or fades. In the conservative scenario, volatility cools, the margin hikes do their job. Speculative excess is reduced, spreads narrow. The market returns to pricing gold mostly as a financial asset, with physical premiums contained. In this scenario, the story becomes, see, it was just risk management, and the public moves on. In the moderate scenario, the tightening reveals weak hands. Forced selling in paper markets pushes prices down in bursts, even while physical premiums remain firm. This creates a confusing tape. Price down, demand strong. That confusion is exactly what dislocations look like. Over time, the spread becomes a persistent feature, not an anomaly. Participants adapt, but at the cost of liquidity. In the aggressive scenario, the system hits a constraint it can't smooth over quickly. That could be a logistics constraint, a sudden demand for delivery, a funding shock, or a cascade of margin calls. In that environment, paper markets can see sharp moves as positions are closed for collateral. Reasons: while physical markets show scarcity through premiums, delays, or shifting flows. The key point is not the direction of price in a day. The key point is that the market begins to price settlement risk. Notice what none of these scenarios require: a dramatic headline. A spread can widen, a margin can rise, and the market can change its character without a single front-page event. So what should you watch if you want to know whether this stress is building or dissipating? Watch margin announcements and risk control changes across major venues. When they happen frequently and close together, it's a sign that volatility is outrunning expectations. Watch the behavior of spreads between spot and near futures and between regional benchmarks. Watch for sudden surges in settlement bridges when futures and spot need to be reconciled. Watch for persistent physical premiums that don't collapse when paper prices dip. And watch for signs that arbitrage desks are backing away, because when the shock absorbers step out, the road gets bumpy fast. One more indicator ties all of this together: how quickly rule changes cluster. One adjustment can be routine, two in 1 week is urgency. When that happens, pay attention to what follows next in the rulebook. Higher haircuts on collateral, tighter position limits, or sudden shifts in how contracts can be closed or delivered. Those are the levers that separate a contained wobble from a broader reset. Markets rarely announce the reason in plain language. They announce it through constraints. And when constraints rise, the smartest desks stop arguing about narratives and start counting ounces, cash, and time everywhere, daily. Now comes the divide. And it's not about intelligence. It's about where attention goes. Most people watch price and news. Institutions watch rules and constraints. Retail sees the move after it happens. Institutions see the conditions for the move while it's still quiet. They see a margin hike as a warning. They see a widened price limit as permission for larger swings. They see a rising collateral requirement as a forecast of stress, not as a reaction to the past. And that is why the wealth gap so often looks like an information gap. Not secret information, structural information. The kind of information that's publicly posted, but emotionally ignored because it doesn't feel like a story. The story is dramatic. The mechanics are boring until they aren't. If you take nothing else from this, take this. When gold and paper diverge, the market is revealing a truth about settlement. And when margin rises rapidly, the market is revealing a truth about risk. Put those together, and you're not looking at a random spike. You're looking at a system trying to stay stable while pressure builds underneath. This is channel name, where we decode what matters before its headlines. If this connected dots you hadn't lined up yet, you know what to do. And remember, the question isn't whether markets can get volatile. The question is whether you recognize the signals before volatility becomes the only thing anyone can talk about.